Live from the Real Asset Queen studios in Kalispell, Montana, this is the Real Asset Queen Live, the one and only show about connecting people, process, and money. Each week, you'll hear mind-blowing interviews from top industry thought leaders, as well as actionable tips and strategies that you can implement in your finances, business, or investing life. Please welcome your host, a former healthcare executive turned entrepreneur, investor, and efficiency expert, Michelle Kimbrough.
Hey everyone, welcome to the Real Asset Queen Live. Thanks for joining us again. We are on episode 22 and we have Mitchell Day with ProVison back with us again. And this time we're going to be talking about building your wealth. Some housekeeping. So we are not financial advisors, CPAs, tax attorneys, any of the above check boxes. So please, anything that you hear on our show, please take back to your respective person and make sure that it fits your particular situation. Next week, exciting, we have Zach back again, and we are going to be talking about the science of business. So we're going to get a little technical with the medical stuff, and we're going to dig into what makes entrepreneurs tick chemical-wise. So Mitch, thanks so much for joining us again. It's always a pleasure having you on the show. Mitch is a longtime CPA, to over 20 years of tax experience. And Mitch, I will let you fill in all of the blanks for our listeners. And we always ask for a fun fact. And I think the first one, you divulged that you actually traced back your lineage to Jesus. And forgive me, I forgot what the second one was.
No,
So we have you.
I met a descendant of God.
Yeah. So tell us a little bit more about yourself and your fun fact today.
All right. Well, I'm Mitchell Day, everyone. I've been a CPA for 20 years since I immigrated to the U.S. from Canada back then. Prior to that, I used to be a portfolio manager, investment advisor with Merrill Lynch and Royal Bank of Canada before switching gears into the world of tax. During my 20 years, I've worked in a variety of firms, both public and private, highlighting on the private side, a lot of construction and real estate. And on the corporate side, I worked 7 years at Bank of America doing tax planning and broker-dealer transactions there, and also small stints at a publicly traded real estate company in Dallas and at Caesars Entertainment. So today's fun fact is my birthday is the 12th of July, which is a holiday in the UK and Northern Ireland known as Orangeman's Day. And they have a bunch of parades, and up until recently, a lot of fisticuffs, drinking, and burning of stuff down in Northern Ireland. So that I used to joke that they celebrated the date of my birth with riots. So there's my interesting odd fact for the day.
For the life of me, I don't know where you come up with this stuff, but man, you sure are unique. I'm gonna have to remember that we're rioting on your birthday, July 12th.
Yeah. Yeah.
No, we're not rioting. Just kidding. But we can drink some Guinness.
Exactly.
So last time we had you on, I think we talked about tax planning and versus tax preparation. And part of that strategy as you're doing the tax planning for the year, and I do believe that you meet with your clients quarterly, but part of that is building your wealth strategy and what that looks like. So talk to us more about it. Is it really more than just stocks and bonds?
Yeah, you have to take very much a holistic approach, because one of the misnomers everyone thinks about is, and the financial planning industry really plays a part of this, but is that they say, okay, if you want to save for retirement, because traditionally it was always you save money in the bank, or you had basically a 30 and out pension. And as the financial industry has really evolved, we've gone away from defined benefit pensions, unless you're in unionized workforce or you're a government employee. And now it's like, well, you got to save your own. And a lot of people are going, well, you just got to have your classic 60-40 equities bond portfolio and kind of tweak around on that. And that's a real disservice to a lot of people because it's more than just that, because financial markets aren't, everyone is not necessarily always a barometer of wealth, because it's like, because you get points, because markets are not truly efficient, because the idea is that it's a pricing discounting mechanism, but sometimes equities are overvalued as they were on and off in the last 20 years, or you get periods where they're significantly undervalued, like in times in the 70s, or actually between the time of the Wall Street crash in 1929 until almost the mid 1950s, where depending on where you are in your life, financial assets aren't always the way to do it. And one of the big things that people have to think about is with a wealth plan is, okay, how am I going to create income for the future, so that either I'm too old to work or I don't want to work. And you have to look at various different income streams, and you got to think about it outside of interest on a past savings account, dividends from a stock. You look at it in terms of income producing assets. It could be owning a business, it could be investing passively in a business, or the big one that a lot of people have found out is just using real estate and creating passive income from there. And the idea on risk management is you want to be diversified against all asset classes, not just stocks, bonds, cash, but you want to look at financial assets versus non-financial assets, and having cash flow from as many different sources as possible, where they have different strengths and weaknesses depending on where you are in the economic cycle, so that you're not overly reliant on one source, where if one becomes impaired, you're not destitute. And that's the first part of a wealth plan, where it comes in. And then obviously what dovetails into that is taxes is probably one of your largest line item expenses if you look at your personal finances, a profit and loss statement. And you want to try to manage that to minimize it, because the more money you have after taxes, the more you can reinvest and create more income.
Yeah, that is great points. And I think traditionally when people think of investing, they think about the stock market or the bond
Mm-hmm.
market, right? And
Mm-hmm.
we know a lot of 401ks and employer sponsored 401ks, uh, where their funds are right now are in the stock market. And even though today we're trading up above 32,000, we were below 30, and we know that it's overinflated. We hear stories about these zombie companies that have no value, but their stock price just keeps going up and up and up. I think Meta, formerly known as Facebook, they were down 22% with their earnings report on Friday, and the FANG stocks aren't doing really good. So I think people are starting to see, and we did, in 2008, as well. We started seeing our retirement accounts that were housed in those buckets start to erode. And that's okay, I guess, if you're 20, but if you're 40, 50 and don't have much longer to work, and you're seeing 50% or more of your investment in the stock market being blown out the window, you start wondering what are other types of things to do. So I like what you said about having multiple streams of passive income. So what's an optimal number? Is that 2, 3, 4, 6, 7, 20? I mean, what is the average?
Well, ultimately the answer is it depends, because you have to look at it in terms of what's your appetite for risk, what are you able to save, what is your investment horizon, because talking to a 30-year-old, their investment metrics are going to be a lot different than, let's say, you and I, which have a lot less time on there. So obviously risk is involved on it. Risk is obviously a piece of that. And it's also where are my funds located? Because obviously if it's in a company 401k, you're much more limited with what your options are and how to pull that out and invest it outside into hard assets. But the way I normally think about it is I don't want to be 100% in financial assets. I want to own hard assets to a percentage. That percentage really depends on where we are and what your appetite for risk is. Obviously, you want to have a significant portion of that outside of financial assets where it's not based on the mercies of the market, where you have stuff out there. And really, it boils down to understanding each and every individual where they are. But having zero in what we'll call alternative assets is not a good answer. But depending on where you are, it should be significantly more.
Right. That makes sense. And when we talk about cash flowing assets, we're talking about real hard assets. Can you define what that is in case somebody doesn't understand the difference between that and the stock market?
Yeah. All a financial asset is a claim, is a percentage ownership. It's an intangible. It's a percentage ownership of a physical, of a hard asset, which is normally a company with assets, liabilities, and revenue and deductions. But because it trades on an exchange, typically, and it's publicly traded, its price isn't necessarily based on what a stock is. Because traditionally, when you look at a company, the traditional way of valuing that is the old school Graham Dodd method, which is you kind of estimate what future earnings are, you discount it based on a rate relative to what the interest rates you think are now, what they are now, what you think they are in the future, and you add a valuation multiple based on that. Stock markets don't necessarily work like that these days anymore. It's no longer representing what true value is. Now, if you're a value-based investor, you can find stuff that way. If you own a hard asset, you're not at the mercies of whatever the bid and ask is on the market. You're dealing with owning hard real estate, hard precious metals, a hard interest in a private company or a private syndicate or a private business that's on there. So it's hard assets in the fact that they're tangible. You can touch most of these. It's not based on I created an app or I created something or I have something that trades. I have some investment instrument that trades on a market. So it's something tangible. It's something tangible and is not readily traded. It's much more illiquid, but you actually have a much more physical claim on things than just owning a share certificate that says, "Oh, I own a fraction of a company."
Yeah, no, that thank you for that definition. I had my friend Stan on with Apex Bull, and we were talking about market manipulation. And for the retail investor, it's very hard to play in that realm with as highly manipulated that market is. And you touched on gold and silver. So when we talk about precious metals, we're talking about the real thing that you can touch and lick if you wanted to. I don't lick my,
Hmm.
but I mean, you could, versus, ETFs,
Yeah,
trading gold and silver on the market, that's still paper trading and it's not the hard asset. And I
yeah.
think, where we're at right now in this inflationary environment and just, all the things that are going in the world now, I, I think it's behooves people to own those hard assets and look at them. We're
Hmm.
seeing multifamily, some of the investor sentiment, is declining. But that doesn't mean that there's still not really good deals in real estate, and not so much single family homes, but commercial real estate and multifamily real estate. If the underwriting is tight, there's still really good deals. But
Yeah.
I think moving your money out of the stock market or even the bond market at this point, because the 3-year and 10-year yields are crazy. We're hearing things that inverse curves. So for me, I like the protection of, holding the real thing, and essentially being your own banker, right?
Yeah.
You know, like you said, the stock market, you're at the mercy of, JP Morgan Chase. I don't know if we can say names, but I just did, and the bigger brokerage firms. And it costs money to trade.
Yeah. Yeah. Well, it's not only that, but it's alternative investments also have certain tax advantages that stocks and bonds don't necessarily have. And there's always values out there because everyone's concerned about one of the beautiful things about real estate and alternative assets is that there's values out there. You just got to look for them because it's like when you're buying a house, it's like every house is unique in its own pricing and it has its own unique attributes. And because it's in a liquid market, there's often values to be had if you basically are willing to pound the pavement on things.
Right.
And the problem is that on a stock market, it's easy to get a price because it's right there and you can already figure it out. But if you're willing to do your due diligence and you have an investment discipline and you stick to it, there's bargains to be had, even with the rate environment where we are. It's just they're harder to come by. Let's not kid ourselves, but they're out there. But if you do your homework, you can find them. And it's just a question of how wide a net you have and looking for it. Because the beautiful thing about this technology, like we're having this discussion now and we're several states apart and we're talking to people all over the place, is that you're able to find hard assets in real estate and businesses and that at the tip of your phone, which is what I'm talking on right now because my laptop's kind of funny. But there's opportunities to find out there. At least you can you can start with a wide search and look throughout the place and then find things. And because of at least technology, it gives you the ability to find hard assets anywhere in the world. And it's just a question of doing your due diligence and keeping a discipline and not overpaying for the assets, because you can find things that yield. It just takes time, and it's a little bit more difficult obviously now, but it's still very rewarding because people can make money in up markets, people can make money in down markets. It's just a question of how do you find the value in sticking to your discipline on it.
Yeah, 100%. And I think that's why I like syndications, because the thought of myself going out and purchasing a 400 unit apartment complex seems very daunting. But, through syndication, you pool your money and resources together in your team, and it becomes that much more doable.
Mm-hmm.
So talk to us about, when we're looking at building, our wealth strategy. So let's say, we're going to buy some precious metals, maybe we're going to do an apartment syndication or some other alternative, asset investing. How do we take into account taxes and estate planning?
Well, there's a couple of those are two separate issues, and I'm going to unpack them a little bit differently. So, the first thing you always have to understand is whatever you are investing money into, you have to understand how's the revenue code treating it. Now, so obviously, if you're in the crypto world or you're in just or in stocks and bonds, you buy something, you sell something. The difference is a capital gain, and depending on how long you own it, it's either going to be short term or long term, and that's going to dictate the rates. Now, when you're dealing with real estate, because the rules are a lot more different in there, because the code is very friendly to real estate, you deal with things versus active versus passive losses. Now, if you're in a syndication, you're typically passive, unless, of course, you're a GP, which makes it active, which means how you can use the losses. Because even if you're a passive investor, what happens is quite often is with a lot of syndications is they are generating cash flow, but due to the beauty of depreciation, they often have losses for tax purposes, which means that means that income is more or less sheltered due to the losses on there. Now, if it's passive, we pool all our losses and income together. And if we have a little bit of income, we report that. If there's a loss, we go to zero, we carry it forward next year. But at least in that sense, until you actually have a liquidity event like selling it, quite often you're getting your cash flow tax free on it. And that's something to know on there versus putting money in the market, because you have that tax deferral in there. So it's a big part of how we think about things, because the way you got to think about it is, what is my after tax return? You always got to look at taxes as the cost of doing business, and that's going to impact your return. So when you're comparing like different investments, you have to put that into the equation to figure out what gives you the best after tax return long term.
Yeah, that's brilliant. And that's why I always advise my investors, please, whatever offering I have, I encourage them to go back to their CPA and review it with them, because what I'm offering may not be a good fit for them, but maybe it might be. And I can't make that call because I don't know their tax basis, and I don't know what other strategies are in place. So
Yeah.
and that's huge, looking at it that way. And thank you for touching on the real estate side and, unpacking, what the losses look like, because there's always three sides of the coin. I think that's what Robert Kiyosaki says, right? So,
Hmm.
not only is it the cash flow that's coming in, but you also have to take into account the taxation and how it plays into your overall
Hmm.
strategy and what your investment goals are.
Well, yeah.
It's to define that is huge.
Yeah. Well, the big thing is like what I tell people is that taxes is going to be one of your largest line items on your personal financials. And the problem is that, and this comes back to from our previous discussions on tax strategy, is that a lot of people just throw their hands up and it's like, it is what it is. I can't do anything about it. And then come January, it's like you give your papers to your CPA, he gives you a return and you pay the IRS. But if you change your thoughts on that, is that your tax bill is no different than managing your mortgage payments, managing your electrical bill, managing all this. It's like once you start putting it into your mind, is that it's something that I can measure, and that to a certain degree, that if I have an open mind, I can manage it depending on what I do and what my facts and circumstances are. Because if you think about it, what the IRS, the Internal Revenue Code is what it's saying is, if you can show me, if you can document this fact pattern, you can have this deduction. And that's the way you got to think about it, is that with everything in life, it's like, you show me the fact pattern, I show you the deduction. And a lot of things is just changing things that you're doing and just thinking about it that way. It's like, hey, if I make these changes, I can get a better tax result on this. And that's really what it boils down to, is starting to think about it right off the bat. Because most of us are used to having a W-2 job. They take the money off the top. We don't see it because it's taken off before we get paid, and we ignore it. And what you got to think is, that's money that's put aside. I got to start thinking about ways on what can I do with the money I have left over to create deductions to get that money back.
Right. I think one of Tom Wheelwright's best quotes, if you want to change your tax, you got to change your facts, right?
Yep,
I mean,
exactly.
that is so true. And when you start framing, your financial life and investments and even your W-2 income, if that's what it is, when you start
Hmm.
framing it in that manner, you start seeing things differently. And I think a whole new world opens up. At least I know for me, when I first stumbled across this, I was like, oh, okay, I'm all for paying my fair share of taxes, don't get me wrong, but I am pretty sure I have overpaid over the years because I was just take the money out of my check, take the money out of my check, and I
Yep.
had no investments, no write-offs, and it's really sad. And I talk to people all the time that have huge tax bills, like six
Hmm.
digit, 7-digit tax bills, and they're business owners and they had a taxable event and they have nothing, and
Yeah.
they've got these big bills. And so yeah, no, that and when you're building your wealth strategy, it's so important not only to look at how that tax and estate planning is now, but then also when you do want to retire, because you
Yeah.
don't want a big tax bill, depending on where you're putting your money, when you go to take it out, right?
Yeah, well, that's exactly it. And one of the big parts that ties into it is we have to put a value on our time, because there's a lot of tax strategies that are out there, but they involve a lot of time, like being a real estate professional. And it's like, because a lot of people talk about that. It's like, hey, if I put this time in, I can save this much. But what you got to do also is say, okay, I got to put in so many hours, and if I'm going to save this much, it's like, you've got to put a time on it, because it's like, are you going to do that for $5 an hour, $10 an hour, 50? Like, you have to put a price on that. because it's like everything else in life. It's like that work-life balance, or whether do I fix the car myself or hire someone else? You got to put a value on your time to figure out whether it's worth doing it.
That is so important because I talk to a lot of real estate investors, mostly, single family home investments or maybe a,
Hmm.
a small duplex or something like that. And they're changing toilets out. And I always laugh when people are, in the weeds that much because their time is money and it should really be spent looking for their next acquisition, not
Hmm.
doing a toilet. you know
Hmm.
I mean, that you can get skilled labor to do that, and I know I've done a lot of home remodeling, and um I don't know it all, and I often have gotten myself into trouble, and it costs me more,
Hmm.
it's not my expertise. But so, what are some good first steps that somebody could take, in starting to build their wealth strategy? What does that look like, Mitch?
Well, the first question, and I kind of put it as an Aristotelian question, which is what defines the good life? It's really a philosophical question because there's obviously a financial component, but there's a personal, a spiritual fulfillment element of it, and there's a legacy thing. So what we're trying to do is really think, what are my values and what things are important to me? Because some people, I have some who are like, I want to be able to, I want to have this X amount of money because I don't want to work, or it might be, I want to have time with my kids because my kids are growing up. I don't want to be working all the time, or like work for charity, do things like that. It really starts off with taking, if you will, a lot of self-reflection and sitting down with your significant other and your family and really defining what's important, because you have to have those values in there. Because yeah, it's like I can set you up whatever strategy you want to save money on taxes, but if you're not fulfilled by it, or it's drudgery, or it doesn't allow you to do the other things, then why are we doing it? Because it's just, that's where it starts to begin with. Once you have that defined, then you can start doing the roadmap on how do we get there, and how do we do it while achieving the returns we need and the tax efficiency we need to get there. And that's really what it revolves around, is just figuring out who you are, and what really you want to, for lack of a better phrase, what do I want to do when I grow up?
Yeah. Not saying we're ever going to meet that grown up state, but the pie in the sky, what do we want to do? Yeah, no, I think
Hmm.
that's really great because, you can pay a lot of money, to a tax wealth strategist to build that plan. But if you really don't know who you are inside and what you really want and what legacy that you want to leave, it could be meaningless and money that you just left on the table, right? So I think that's good for people to understand, what it is that they want out of their wealth building strategy, because it's different for everybody. And I
Yeah.
think each age bracket, it's different. For me, I have elderly parents that I'm taking care of, and I need to make sure that they are taken care of well, and just resources, and it's all about them and
Yeah.
family, and I want to
Yeah.
leave a legacy. But for
Yeah.
somebody else who's 20, maybe something different.
Well, yeah, because the paths we take on our lives, facts and circumstances change, because it's like mine changed a lot just because I have a special needs child. So that change, it first of all changed a lot of my priorities in my life. Like it changed me a lot as I think it made me a better person, because it forced me to, like, I have to care for them. I have to do this. And it's like, it's made me more compassionate, but it also rejigged a lot of things that were in my life, where it's like, no, this is what the focus has to be. And that, as a result, my wealth strategy is like, I have to make sure that he's taken care of when I'm gone. And like, that's a different set of circumstances versus other families, or as I said, the recent graduate out of school who wants to change the world. It's like they have one set of goals, but once again, marriage, kids, life events, we have to be agile enough to recalibrate it depending on what life deals us.
Yeah, that is so true because the 18-year-old Michelle was different than the 30-year-old Michelle, and that's completely different to the 55. Yes, I said my age. 55-year-old Michelle,
Hmm.
priorities changed, life changed, and some things that I thought were important in my younger days, not so much.
Yeah.
So yeah, no, I think that's really good advice, Mitch. So I'm going to open it up for questions, see if anybody has any questions, because it's not very often that you get to talk to a CPA who is also a tax and wealth strategist. So there might be some questions. But Mitch, while we're waiting for some questions to come in, why don't you tell people where they can contact you?
All right. Well, as you've probably seen in the intro, I work for a firm called Provision Wealth, which is located in the Phoenix area. Our website is www.provisionwealth.com. Or if you want to call and set up an appointment for me just to shoot the breeze about what your goals are and about how we can help you, happy to take a call and talk to you all. I can be reached at 480-467-4400. So operators are standing by waiting for your calls.
And I also have your email scrolling at the bottom, so hopefully people collected
Yeah.
that. So Amber says, great topic. Thank you, Amber. And she's welcoming back. Thank you. And Mitch.
Mhm.
So that's great. So Mitch, we're going to have you on again. And I think we're going to talk about building your wealth or something. Today was strategy, and I forgot what the other topic was, but we did have another one that we're going to do. And
Mhm.
there are times are changing so quickly, and I think really being able to wrap your head around the financial education piece, and that's
Yeah.
why we do this, because we don't teach it in schools and people don't understand what's going on. And I'm fearful for friends that have CalPERS right now, back in California. I'm very fearful for them. And people that just typically have their money in a 401k. And so I think the
Yeah.
more educational opportunities that we can provide will help. And thank you for being willing to jump on a call with people and walk them
Let me
through.
chime in with a big theme on this. Is for everybody. Is just it's understanding risk. It's that risk it's like, well, obviously we have auto insurance for risks getting in an accident, medical insurance for this, but there's all sorts of different types of risks that we're not always aware of, because one of the big things that we have, and this is just behavioral psychology, is that we overestimate we overestimate some risks and we underestimate many others. And one of the big things that you got to look at is that there's other risks out there that are much more significant in our lives than the ones that we worry about day to day or we see in the news. And the question is trying to open up our eyes to all that. And it's like, okay, how do I mitigate that? And that's a lot of the things we do in wealth strategy, is try to reduce our overall risk, so that the idea is that if something isn't doing so well, we're making it up on the other end. Or if rates go up and inflation's going up, we have ways to mitigate that. It's the whole idea is that understanding, once you understand risk and you understand how capital and risks and everything works together, it helps you also build a plan much better long term and makes you much more resilient for the tough times that might be coming down the road.
That's so true. And I think once you understand that, investing is not this big, hairy, audacious beast.
Yeah, yeah,
You know,
because when you start learning to invest about mitigating your downside, because one of the big things that most fund managers will tell you is that if you call your losers and you figure it out, the winners will take care of themselves. And it's kind of the same idea, is that we're always thinking about what's our acceptable level of downside and let the growth take care of it.
yeah, that is so true. So true. Well, Mitch, it looks like we have a quiet audience except for Amber, who loves
Hmm.
our topics.
Yeah. Hi, Amber.
She loves them. I know she'll be calling me after this. What do we do now? So be good.
Oh yeah.
Mitch, thank you so much for your time. You've always been very gracious with your knowledge and just your presence. So we do appreciate you so much, and we will see you back again.
All
So
right.
yeah, so I hope you have a lovely evening, and I can't wait for July 12th where we can riot and drink um, Irish beer, I guess.
Yeah.
So don't forget, next week we have Dr. Paul Zach. He is Dr. Oxytocin, and we're going to be talking about the science of business. He's got a great book out called The Trust Factor, and I think he just released another one. But we're going to be talking about those neurotransmitters that gets into the entrepreneurial brain and makes us tick. So pretty interesting stuff. Stay
Yeah.
tuned next week. All right.
Okay. Sounds good.
Thank you so much, Mitch.
All
Talk.
right. We'll see y'all later, and till next time.
You bet. Take care, my
All right.
friend.
All right. Bye bye.